Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Market Wrap, where we talk about the biggest moves in the markets this week and what is driving them. I'm Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth.
And I'm Stepek, senior reporter for Bloomberg and Money Distilled newsletter author.
Okay. Now, John, we're recording our markets roundup a little bit early this week for two reasons. Well, I'll say first, it is Monday, June the 23rd, Brexit Day, but that's not the reason for recording early. It could be, but it's not. The first, the great John Authors is in London. John, of course, is senior editor for markets and a Bloomberg Opinion columnist. His Bloomberg newsletter, Points of Return, is a must-read. You must read it after you have read the Merryn Talks Money and the Money Distilled newsletter, but it's a great third for the week. And in a past life, he was chief markets commentator at the FT, so we knew each other there too, of course. So first of all, welcome, John. Good to have you with us.
It's great to be back in London.
Also, there's a second reason for this. We felt we needed to get some analysis on the markets out immediately because, of course, global markets are reacting, or not actually reacting as much as you might think they would, to America's decision to get directly involved in the Israel-Iran war. President Trump ordered strikes on nuclear facilities in Iran over the weekend. So we are going to get into what that decision and the possibility of retaliation from Iran means for oil, for the dollar, and possibly for crypto, among other things. So here we go. John and John, this is going to be very trying as a conversation for me, isn't it? John and John, I just said we're going to be looking at the market reaction, but so far there isn't really that much. I mean, John number one, John Stepek, you published a piece this morning. Why is the market shrugged off escalation? What is the answer to that? This is scary stuff.
So the US came in because they're the ones who've got the bombs that are big enough to kind of blow up the nuclear labs that Iran has got. But that is all they want to do. Like, my best guess is basically the market doesn't actually see this as an escalation and is hoping that it won't go beyond this. Because although everyone keeps saying that Iran could close the Strait of Hormuz, if it does that, that really is a double-edged sword because, you know, a lot of the world's energy goes through there. Mm-hmm. But the problem is that actually that's also how Iran gets its oil into the world, and Iran needs the money. It's also how China kind of relies on it too. Qatar relies on it, and they are both. Iran doesn't really have allies, but it does have people who it hasn't annoyed, in China, and Qatar are among those. So basically, if it shuts that off, it risks alienating the few people who would still support it, and also the US would then, take action to actually do something about it as well. So you're dragging the US further into the war again. So I guess the thing is that is, as far as I can work out, that's why markets are basically shrugging this off, because either it escalates from here or it doesn't, and the chances of it escalating still seem lower than the chances of it actually escalating.
Okay. Yeah, is that how you see it, John?
I didn't catch anything in there that I didn't agree with. I mean, the whole point of risk management is that sometimes what's likely to happen doesn't. But plainly, for the reasons John just set out, the odds are that we don't get a serious escalation from here. Iran has already been very badly weakened. As John said, if you close the Straits of Hormuz, you annoy China, which is basically by far, more than half of their oil exports go to China. They really need to keep China being friendly. And it's also not so much of an all or nothing thing, closing the Straits of Hormuz. There are two sections which are only 2 miles wide. But it would be an invitation for the American fleet to come in and sink the Iranian Navy, which they probably would do. That obviously would be an escalation. It would raise the risks that you actually saw some US combat deaths, which makes escalation bad. I'm not saying this is good, but it's just that Iran can see this coming, and that in terms of the implications for the flow of oil and the price of oil, which is what really matters, the odds are high that oil is just not going to go anywhere that the market can't handle. Also, you have the underlying backdrop is that oil demand is on the low side. and oil supply is on the high side. Hormuz, depending on whose estimates you believe, has 20% of oil exports go through that strait. So you can't shrug it off just like that. But if there was a time to have a big one-off threat to oil supply, this is quite an easy one for the market to deal with. That's the exact opposite of 3.5 years ago when Russia invaded Ukraine, when supply was weak and demand was increasing quite rapidly in the wake of as the world woke up after the pandemic, and that helped create that spike then in the oil price.
The other thing you might add to that is when we use this 20% number, and it's very hard to verify 20% here or there, but it's 20% of the world's oil flows. So the fact that the US, for example, is now energy independent, thanks to Shell, etc., the great game changer, the idea that oil should have a very big geopolitical risk premium attached to it might have changed over the last decade even.
It's certainly weakened. There's this concept of the oil burden. You take a look at the cost, the total expenditure on oil as a proportion of GDP, and it's far lower than it was in the 70s because we're a less energy-intense economy. There are far more services. The industries that do make things generally do so in a much more energy-efficient manner. Doesn't mean that you can ignore it, but it's hard even to imagine anything that could create the same shock, same level of inconvenience to global industry that happened with the embargo of 73.
Yeah, I do want to clarify there because people tend to sometimes deliberately misunderstand this kind of thing. What you mean is that oil, the expense of oil, is a lower percentage of GDP, not that the US or the UK or any country used less oil than they did previously. It's not an absolute, it's a relative
precisely
thing speaking about here. I just want to be clear on that.
But in percentages, it's much less significant than it was.
Okay, so oil seems relatively stable-ish. Equity markets have barely reacted either, John.
That's
John number one.
Sorry, I guess that's downstream of oil, really. I suppose breaking it down, this has happened because the world, or the US and the bits of the world that we're in, certainly don't want a nuclear-armed Iran. And that's why the US went in and did this one-off thing. It's not like, I know a lot of people, I think sometimes with malintentions, have tried to draw a parallel between this and Iraq. There's nothing like it. The US is not looking to occupy Iran or even regime change. I can see why Israel would want regime change, but that's a different issue. So as far as the US's involvement is in this, they want to make sure that Iran can't get a nuclear weapon. And also I think the other thing you have to remember is that Donald Trump's base, one of the reasons Donald Trump was popular with his base, and also, between 2016 and 2020, he managed to avoid getting the US involved in any significant wars, which was an unusual feat for a president, and he kind of wants to maintain that streak. So the chances, it leans heavily against the US getting any more involved in this war, which is another reason why Iran will probably, unless the regime is completely desperate, will be thinking it would be better if we don't close the Straits of Hormuz because we don't want to escalate to the point where we drag the US in. So again, it just sort of boils down to this thing where there is, from an equity market investor's point of view, there is not really any point on worrying about this until it does get worse. So why do anything with your portfolio today, which kind of, to me, explains why markets are flat.
I'll give you that, but I would have still thought that as geopolitical tension around the world ramps up and up and up and up, there would come a point when whether the oil price is rising or not, whether there's an obvious feed through to inflation or not, whether there's an obvious feed through into corporate earnings or not, you might get to a point where everyone would just start to feel nervous and think to themselves, you know what, I can't really pin down what is making me feel scared here, but I think I might hold fewer expensive equities and I might hold a little bit more gold. And I might just, maybe a little cash for now because it looks a little scary out there. And that's the thing that surprises me. I would have expected by now the market to stop shrugging off absolutely everything. You make a great case, but this doesn't really matter. Maybe it's fine. Who knows? Let's get hysterical. But, over the last 6 months, it's been thing after thing after thing after thing after thing. And everyone's still, maybe it's fine. I would have thought by now we'd have moved into, maybe it isn't fine territory, but call me a pessimist. I don't know.
Okay, if I could invoke continuing the coterie of people connected to the Financial Times, our old colleague Rob Armstrong,
Yeah.
who has suddenly become much more famous after he came up with this acronym TACO.
Yes. Yes.
Trump always chickens out.
Damn it, John! Why didn't one of us come up with that, and we'd be more famous? Why him?
That did bother me too.
Yeah, be cleverer.
That
Be
thought
cleverer.
has crossed my mind. That being said, I'm quite happy not to have Rob's inbox at the moment, which might be even more of a frenetic read than mine.
Do you know, we can fix that for you. We can talk about crypto in a minute.
Yeah,
Your inbox is going to be the same as his. Anyway, carry on.
The point is that the taco trade had some considerable validity to it. That's how it went viral, because on the tariffs, Liberation Day tariffs with China, he's threatened to fire Jay Powell from the Fed. He made a number of threats, and if you look back pre-Liberation Day, the really extreme tariffs, he says he's going to put tariffs on Colombia, and then he doesn't. He basically says he's going to put tariffs on Mexico and Canada because of fentanyl, which was ludicrous in the first place, and then they basically announced these are the people we're going to have on the border. And Trump says, okay, no more tariffs. And then you read the small print and discover these are exactly the same number of people they had on the border before. So, there is this sense that Trump does always chicken out, that you can safely ignore him. And that the one time people really did react negatively, reacted to a geopolitical shock the way you would expect, which is the Liberation Day tariffs, which were pound for pound, possibly the single biggest policy error of my career. Just unbelievable, stupid, terrible thing to have done. The lesson from that is you might be right in this is a terrible idea, but you should also have realized this is such a terrible idea that it's not going to happen. I'm not selling. And the people who, and plenty of people made a lot of money out of second guessing that one, and they don't want to make the same mistake again. I'm nervous about making such a reaction. It leads to overconfidence. Most Middle East conflagrations end up fine as far as the supply of oil and the market is concerned. Every so often there's a Yom Kippur war. We do know that, as we were saying earlier, the risks of something really terrible on the scale of the Yom Kippur war are definitely lower. But there is this ability to forget that every so often something might go wrong.
Yeah, every now and then something bad really does happen.
There's also just the ingrained BTFD, because people who have not bought the dip have been kicked in the face really hard for about the last 15 years. And that just, that psychology dies hard. So I think any bias towards an excuse to buy is, or not to sell, is kind of, embraced by the market.
BTFD and FOMO.
Yeah, aye.
And John Authers, what do you think might bring that to an end? How long can it really go on that every dip is bought when, we've looked over the last few, we've looked at the direction of flows from the baby boomers, we've looked at the direction of flows from foreign investors, etc., and they're all going the other way. Yet you have this huge surge of retail investors who will come in and buy any old dip. What makes that end?
I actually flipped through Malcolm Gladwell's The Tipping Point recently. And basically, it's quite a frustrating book if you actually read it carefully. It says that every so often you come to a tipping point and look at these historical examples of tipping points. He doesn't tell you how you can see them coming in advance or quite why that was the particular tipping point.
Gladwell, you say?
So sort of, if you look at the great market bottom of 1982, you can sort of talk in general terms about why it happened. Paul Volcker was winning the battle on inflation. Ronald Reagan was doing what he was doing. The market was really absurdly cheap by that point, 7 times earnings or whatever it was. There was no one moment that triggered anything. It was just after about 6 or 9 months, you noticed that the market really was trending back upwards again. Similarly with the dot-com bubble, it's not like the Lehman Brothers where people knew there was a problem and then there was one clear catalyst to catapult into serious crisis. There is no clear reason why the dot-com bubble burst when it did. It just did. And you could tell it would burst at some point because it was so absurdly overpriced. So, to that extent, valuation doesn't help you. It tells you that there is a risk that something is going to blow. It doesn't tell you anything at all about the timing. In terms of what might change things here, if the small tail risk in Iran comes true, that would be serious. That would be very serious. So, meaning if we actually do find that there is a conflict involving American soldiers and sailors and Americans getting killed in the Straits of Hormuz, if we have more bombs because it turns out they didn't actually take out what they needed to take out in Fordo, and this time some radiation leaks. I mean, these are things I don't think will happen, but are more conceivable than they were a few days ago, and some of these really alarming things might make a difference. If there is a tail risk we can see coming, which I would take more seriously, it's just possible. We only have 2 more weeks left before the Liberation Day tariffs are due to come back into effect, allegedly. Everybody assumes, I think correctly, that that's not going to happen, but Donald Trump does need an off-ramp. He doesn't like what Rob Armstrong said about him and what everybody else has been repeating. There are risks there that are probably... I did a chart. If any listeners who have access to the terminal, if you go NT news trends, you can go NT tariffs and then NT Iran, and tariffs were already sliding down into irrelevance before Iran took off, and Iran is now gobbling up attention in a greater way than tariffs ever did 3 months ago. So that is quite a big sign that if there is something that's, like on a cartoon character treading on a rake and getting smashed in the face, that's going to be the thing you're not worried about that will hit you. Tariffs, not the thing you are desperately thinking about, Iran.
Yeah, that makes sense. What do you think it might be, John?
I think, the rotation is still happening. The things the US has kind of already peaked, and we're going to keep kind of slipping down that slope. I think people will keep buying the dip, but I can't remember if I mentioned this, and I did probably mention it in the last podcast, didn't I? But if you'd bought British stocks on the day of the quasi-quartang budget, and you bought US stocks at the same time as in the S&P 500, you would now have made exactly the same amount of money in British pound total return terms, in other words, about the dividends reinvested. And that's because the dollar's got a lot weaker since then, the pound's got a lot stronger. And I think that sort of relative rotation is continuing and probably will continue. I do also take the point about, there sort of feels as if there should be scope for some sort of crash at some point, but I just don't know if that'll happen. Yeah, well, no, I don't even. Yeah, in real terms, there's a sort of real terms thing, where inflation's higher and it's eating away at your returns. You're not really noticing it because if you're measuring in local currency, then maybe it's not feeling as bad.
It's interesting what you were just saying there. The S&P hasn't got back to its February.
Actually,
peak,
it hasn't quite, has it? Yeah.
Which gloriously happened on the day the White House tweeted a mock-up Time magazine cover of Donald Trump with a crown on his head, saying he was the king of New York. So if you wanted the curse of the magazine cover, this is a case of somebody executing the curse of the magazine cover on themselves. Other than that magazine cover, which I really don't think was the reason people sold stocks the next day, there wasn't any particular reason why that day was the top. But so far it still is the top, and that's whatever it is, more than 4 months ago now. So who knows?
Okay. And what do we buy, either of you, to hedge ourselves from the difficulties around us? If we're worried about this going further, we're worried about the chance of escalation, we're worried about oil prices rising. Apart from oil, what do we buy?
Gold.
Of course.
Well, nobody got fired for hedging a risk by buying some gold.
Didn't they?
Not recently.
Not recently. Well, Gordon Brown still went on to be Prime Minister after a rather badly timed gold sale. But in general,
there is no karma out there, is there? What about crypto, John? Would you buy crypto to hedge against this?
Oh, which joins this?
I certainly wouldn't.
I'm hoping one of you.
Yeah, I know. We're both hoping to defend the other one.
You're both petrified.
I'm going to say something really. I think Bitcoin is fine as a small allocation of your gold allocation. I like Charlie Morris's approach to the whole bold thing. A lot of gold mixed with a little dash of Bitcoin, but that's mostly for avoiding the fear of missing out element.
And just for the record, John number 1 does not hold any Bitcoin. John
No,
number 2,
I
have you
don't.
got any Bitcoin?
No.
No. Well, there you go. I am the only one of us with any Bitcoin, and I'm the one that gets all the flack.
I mean, it's a question of opportunity cost. I am also a big fan of Charlie Morris, that who actually really tries much harder to put some kind of a sensible, fundamental, fair value on both Bitcoin and gold. And whether or not he's right, I thoroughly respect the fact that he's trying to do it.
Yeah.
What is interesting about Bitcoin in the last few days is that it has behaved exactly the opposite of how it's supposed to, or how, if you go back to the founding, the white paper, how it's supposed to, in that it's behaved like an extreme speculative risk asset. It dips really sharply when we find out that Israel has attacked Iran, and it dips again very sharply, going back below 100,000 after the Americans dropped the bomb on Iran. I haven't checked it this morning so far, but
it's back up above 100.
It is back up above 100.
So
Listen,
done
do
what
you
oil
think
did.
that tells you that it is an extreme speculative asset? I mean, could that be the answer to the question?
That's part of it. The other slightly conspiratorial explanation I've seen is that because people, the kind of people who use Bitcoin a lot are the kind of people who are trying to avoid sanctions. When something like this happens, they might well feel the need to take some profits from their Bitcoin because this is a problem.
Okay.
Well, I hope they're going to pay their capital gains taxes on it.
I have no names and everything. That's actually plausible to me. That explanation, but it's worked terribly as a hedge against the two really bad news headlines of the last couple of weeks.
Oh yeah,
very surprisingly badly.
Okay, perfect. John number 1, John number 2, thank you so much for that. That was really interesting. And now everyone knows, of course, exactly what to do. Super helpful. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review, and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter. I'm at MerrynSW. John number 1 is John_Stepek, and John number 2 is John Authors at John Authors. Very good. This episode was produced by Summer Sadia Moses and sound designed by Blake Maples. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.